I think we can start now. It's 10:32. Good morning, everyone. Actually, I haven't prepared anything for today's call because this topic was raised by YCX earlier. Um, I personally is not really. I personally don't really look at macro to decide my own investment. But I know there are many people who pay a lot of attention to this macro, and it's always interesting to chat about macro. If you read news, I guess most of the content are macro news rather than those company specific news, right? So this is anyone who talk about market definitely is interested with macro. So I'll pass this to YCX. And if you guys have any questions, don't be shy. Just unmute and speak. This is Talk Out Sing Song sessions, casual chat. It's not like giving class or what, right? So feel free just to unmute and chat. Over to you, YCX.
All right. Okay. Yeah. Hi, everyone. So how do I start? Okay. So to be honest, right, a lot about macro is typically unknown. Okay. Like we know that it's kind of like if how to give an example. You know that if it rains, right, more people will bring umbrellas, but you are not certain that more people will bring umbrellas. You think that more will bring umbrellas. Is that kind of that kind of that kind of thing. Like you are never 100% sure that raining will result to more people bring umbrellas. That kind of idea lah. Okay, so but nevertheless, right? Uh, when we are talking about long term, there's some things that matters in the sense that we should account for all kinds of scenarios. Like depending on, let's say we are going out to work, you know that in Singapore, maybe out of 365 days, there's probably like 180 days of rain, right? So you know that there's a half percent chance, there's a 50% chance of rain, and you can do something about it, and that is the point, which is that it may or may not happen, but if it does happen, you have something prepared for it. That's the idea lah, which is actually what macro which is all about. You can't really predict what will happen next, but if and when it happens, you identify it quick enough, you have a first mover advantage in doing something. Yeah, that is the idea of looking at macro, because you never know when Jerome Powell will wake up the next day and say, oh, today we are going to raise interest rates to 1%. The Fed funds rate, overnight Fed funds rate to 1%. You never know when he'll wake up and say that. So, but if he does wake up and say that, what are you going to do about it? Because if you think about what to do the moment he announces it, right, then you are too late already. But rather, if you prepare for the situation beforehand, then when it does happen, you have more conviction to execute. Yeah. So,
But I think here, right, before we go further, right, I mean, macro, the term itself is very broad, right? You can say macro is okay about economy, it's about employment, it's about inflations, all this stuff that is, I would say, as long as it is not company specific, then we can say that they can be grouped into macro, right? Even you can say whether we should pay attention to politics, to like broad regulations, not those that targeted certain companies are the broad one, or change of taxations. All these things are macro. So I think we might need to be more specific. Like today's discussion, are you just focusing solely on the monetary policy, or is it like really like the broad macro?
I think it's really like a broad macro, because to be honest, right, I realized that when preparing for macro is that everyone has a different idea of what macro is to them, because it really depends on what your portfolio is and how you are managing your portfolio. For example, if someone strictly only deals in, like, say, commodities, then a lot of the things don't really apply to him or her. They might just be, I'm strictly dealing with commodities. All I need to do is look at commodity news. I'm very sensitive to commodity stuff, and I don't really care about any other thing. I mean, there are traders like that. Like, there are traders who strictly deal on a sectorial basis, which is why they are into ETFs. So they don't really look at individual companies. But for example, if you are like a portfolio, your portfolio is like, say 30% Apple or 30% Tesla, then obviously your idea of macro is tied a lot to Apple and tied a lot to Tesla. So macro is actually more about, like, looking at all the events that's happening in the world and how it affects your portfolio, rather than a strict, say, macro affects all these stuff. It's more about how it applies to you. That's how I look at it, lah. Right. So
Yep.
so it really depends on uh what you are doing, and how you cater the macro to what you're doing. Yeah.
But
Does that
here,
make
right,
sense?
I will quote the Howard Marks' latest memo. He talked about this macro, whether he is considering macro perspective when it comes to the investment, right? I think the one things which is quite important one, I think the entire thesis is that he said, okay, macro, this is definitely important. Like you said, if tomorrow suddenly Fed raise rate by 200 basis point, or suddenly the tax rate just increased by 20%, of course the entire market will tank, right? You can say, okay, I'm very good at stock picking, I pick the best stock, but doesn't matter, your stock share price will still fall together, right? So definitely macro is important. The thing is not saying macro not important, but it just say that we actually it is very hard to predict the future. Like say interest rate, right? I know that, let's say if you tell me interest rate is 10% 1 year from now, I don't care about long-term investing, all these things, right? I will just sell all my assets. Why should I wait until the interest rate 10% and then the market tank and I still holding on to my stocks, right? Doesn't make sense. So it is important. The thing is that we don't know what will happen to that interest rate, all these macroeconomics stuff, because it could be that interest rate goes up, but it also can goes down, and market itself, right, will price in certain like they price in the expectations already. For example, even if you look at the market in the past 2 weeks, right, you can see that keep hitting all-time high. So I believe that the market has priced in a lower chance of rate hike, let's say towards the end of the year. So those are already priced in, right? So the consideration, if we put in all this macro into our investment, right? The thing is, you have to be very confident that your assessment is more correct than the market. So, for example, if market think that, okay, we probably will start with low interest rate environment for longer than expect, for very long time, and I think this is wrong. I think inflation will come soon, and I think the rate hike will happen sooner. Then, of course, I can take a bearish position on the market, right? But I need to be different, and then secondly, I need to be right, which is very tough, because when the entire market decide on one thing, there's a consensus, right? So if you what you believe is just consistent with the consensus, then you can't arbitrage anything, right? But you can only make monies when you think the consensus is wrong, and then you need to prove that it is wrong. Like I mean, subsequently you just proven that you are right by taking the position, then you earn money lah. But all this is not that easy, That's why there's this thinking that, okay, probably because this thing is too hard, then why not we just forget about it and just don't consider it at all. So I think that's the thesis behind Howard Marks' memo. Yeah.
Understood. It's a fair point, but the thing that how do I put it? Which is that, okay, it's a fair point that sometimes just following the crowd following the herd is a good thing to do. But there's also times when the herd is wrong. I'm not saying that we must always bet against the herd or predict where the herd will go, right? But it's more of like whatever situation happens, right, that we are well prepared for it. I take an example of like let's say Singapore itself, right? When the economy and times are good, Singapore stockpiles money. Singapore trains its army, and Singapore does a lot of different things that are, or create a lot of different initiatives to do certain things. So these initiatives are in place. It might not make sense now. Like, oh, why is there a need for army? Like, why is there a need to have all this money stockpile, all these things? But the thing is, since we are talking about long term, right? The as if, so you think of it as like you are managing a portfolio, and there's going to be times, I don't know when it will happen, but there's going to be some time whereby something big happens, and are you prepared to actually do something about it? That is the thing. I'm not saying that you have to change anything right now, but it's more about like when something does happen, are you prepared? Because preparation is about doing something in advance, and knowing, or it's either about doing something in advance or knowing what to do when that situation arrives. And a lot of the a lot of the things is that people tend to, I mean, from trading itself, I understand the kind of feelings, which is that you see like something is going up, then you have FOMO. You feel that, oh shit, I better get in. What if it goes up even more? I miss out. That kind of things. Then if something is going down, you think I better sell now, or what if later it goes down even more? That kind of things. And these are the kind of feelings that are in play. That it will dominate the time frame that you are thinking about it. But then is it really the right mindset to take? That's another thing. So the the idea is that there's this 孙子兵法 saying lah, okay, 居安思危, right? This is 居安思危 means that, or Machiavelli, it says in peace times prepare for war, in war times prepare for peace. So the idea is that before that something happens, you think about what you might do if and when it happens. Yeah, that is the things. So that, for me, I actually look at, I look at a lot of things, but mainly I look at three main things. One is fiscal policy, one is monetary policy, and one is the US 10-year treasury bonds yield. And these three things are actually pretty simple, in the sense that roughly when they do go up or down, there's typically a very standard reaction to it. For example, say fiscal policy, right? If the government is spending more, you can expect the assets to go up. If the government is taxing more, you can expect the assets to go down. So that is something that is very obvious. And not only is it very obvious, is that the market doesn't react instantly to it. The market eases in the effect. So like, for example, Biden just say, oh, we have a 3.5 trillion spending plan. So you can kind of expect that the prices, they will rise. Yes, they will rise based on this news, but it's not that it will rise overnight by, say, maybe sectorial overnight by, say, 4-5%. But it could be that in like 2 or 3 weeks or a month, it does go up by that 2-3%, that kind of thing. So if you know about something like that, then you can be, oh, okay, so this is the I can actually observe and see, okay, so it does happen this way. But then the opposite happens if, let's say, fiscal policy has like some kind of new taxes or things, or there's a raise in tax or something. You can see that the effect is also eased in, because most people who buy equities, for example, right, they also don't like instantly move their positions. Yeah, like all the big financial institutions, they don't move their positions like overnight either. They move it, in in like I mean, you just look at how Cathy Wood's ARK invest. When they move, they take like a 3-4 month approach to moving. They don't take like a, say, 1-2 day approach to moving, that kind of things. They move in months. Yeah, that is the kind of things that's in play lah for fiscal policy. Then for monetary policy, the most important will probably be the overnight Fed funds rate, which you can also know that if the Fed funds rate goes up, growth assets will go down. If the Fed funds rate goes down, growth assets will go up. Then there's also the other situation, which is that if the Fed funds rate is low for too long, then both assets and assets will go down. That means the assets is less reactive to it. If the Fed funds rate is near zero for too long, so you can see that there's also like a move towards riskier speculative assets when this happens. So then there's also like the US 10-year bond yield, which there's a lot of mixed feelings to this, but based on what I see on the charts, right, it is that the 10-year bond yield is actually an indicator of the overall macro health of the economy. Why I say that is because the 10-year bond yield represents the risk-free rate of return. So the risk-free rate of return, generally speaking, equities need to in order for equity to be profitable, or I mean like go up, they have to be beating this risk-free rate of return. So if the risk-free rate of return is high and the equities are even higher, they are generally speaking that the economy is strong and is doing well. That is the general feeling. And doing well means that the doing well is a very subjective concept, because well to me doesn't mean that things go up. Well to me means that there's less volatility. Right. Well means predictable, and well means lesser opportunity due to lesser volatility. That's what well means to me lah. Okay, so yeah, those are like my roughly the simple guidelines because to go into more in-depth stuff on macro, right, that will require like how it applies to your portfolio. What is your portfolio mixed up made up of, and the kind of things. Then how these kind of factors will adjust accordingly, because like for example, taxes might not affect your sector, or taxes might not affect your portfolio, that kind of things is that's how it is lah. Yeah, so at this point, are there any like opinions or questions, things? Because actually I can otherwise I can move on to like a certain mindset. I have prepared like half of it is about the mindset of doing things. Yeah.
Yeah, let's open for questions. Anyone want to voice anything?
Min Song here. So when you say look at the treasury bond yield, is it?
Yeah, 10 year.
Yeah. Okay. So now I'm looking at the chart for the treasury bond yield. So what can we interpret from recent trends?
So one easy way to do is that you put up a comparison of your interest, of the asset that you're interested in, and compare it with the 10-year treasury yield. and then you can see from that how is it doing, how is it doing compared to the 10-year treasury yield, because the 10-year treasury yield represents the risk-free rate of return. So if your asset is following the same trend, it means that your asset is very correlated to this macro thing lah. And if you see that then you can also see that if the 10-year rate of return goes up or goes down, the chances are that your asset will go up and go down based on the correlation that you see on it. I mean, does that make sense to you? Because let's say if you find an asset that is inversely correlated, then you will know that that the correlation is inversely. So if you just monitor just the 10-year, you just monitor the US 10-year bonds, right? The yield, you can kind of tell where the direction of your asset is going. Yeah. So you try it. Just bring up any asset that you all own and compare it with the US 10-year bond yield. Yeah. Chances are very high that usually there's a correlation, either positive or negative. That depends on your asset. But yeah.
I have I think slightly simpler explanation on how to see the 10-year bond yield, the treasury yield. Actually, it's like actually I agree with what I said. YCX said just now. In the early section. It's quite easy, right? Because imagine that now we are at an environment that the fiscal policy government are spending, they pass the infrastructure bill, all these things, they mail the monies to the citizens. So those are all good, right? Then taxes, I don't think they are like they plan to increase taxes a lot, right? Then on the monetary side, I mean this is talking about when the economy, since the COVID-19 now is slowly picking up, recovery, and then with the vaccine also further recovery. Once there's this economy and market recovery, then the risk on mode is on. So they means that people are ready to take on more risk. So if they are taking on more risk, right, they will shift their monies from bonds more towards the equities, right? So equities will rise. And once you sell down your bonds price will slightly drop, and that's why the yield will go up, right? So, but then let's say if there's something bad happening, like very quickly, like another crisis suddenly is brewing and coming very soon, right? People see that, right? Then they will just flight to safe assets, where they flight to, which is treasuries. Then the yield will drop. So by just observing the 10-year yield, you can actually have a sense on what's the risk appetite of the aggregate investors. So I think definitely you can just look at the equities market also possible. But when you look at equity markets, that's just equity market only, right? Which is a subset of the entire total capital market. So if you look at the bond market, then you can see the entire total picture as well. That's one thing, the risk on risk off explanation. Yeah. The other thing is on the 10-year bond yield is also sensitive to the inflation, which is what we were talking about like quite frequently in the, I think two months ago. You remember when they say, okay, inflation is going to shoot up, then whether it's transitory or not, all this chit chat, and then I think the stock market also affected because of the sell off in the bond markets, right? So all these different bond market, equity market, they are somewhat related, but the correlation is not going to be like 100%. You can't say given the equity market, then I can predict the bond market. It's not so easy. You can see definitely there's some correlation. It's just that not 100%.
Yep.
Stop
Definitely
here.
correct. Yeah, but it's just that to understand the other thing is that I mean there are many big movers in play for money, right? Because money is money. So, and a lot of them, because they are denominated in USD, they make their reports in USD, they look at their funds in USD and things. To them, it's actually about like is about that lah, which is that they will move based on discount. It's just like it's just like it's just like weather patterns like that, which is that you can tell that a general area will rain. You don't know how much rain there will be, and you don't know whether the exact spot will have rain, but you can tell that that general area will have rain. That kind of things, and yeah lah, that is the idea of looking at the 10-year bond yield, and also that's one of the things about it, lor. Yeah, lor.
Yeah, right now it's raining heavily in China, right? You look at Alibaba, Tencent, yeah, the share price dropped so much, right? It's like almost like already, if you just look at that market, that geography, it's like considered like crisis already. Not like huge crisis, but definitely this kind of prices is cannot be explained by random volatility, right? This is like quite a huge drawdown actually.
It's quite close to like, I would say it's quite close to like how many DEFCON status there are? 5, right? Yeah, so I think it's close to like DEFCON 3 already, yeah lah, for Chinese stocks, yeah. Which depends on like I mean, again, it depends on like what you are familiar with, what you're comfortable with. Then you decide whether to buy or sell in that area, lah. Yeah. So there's no clear answer, but it really depends on your own how I mean, like what you are focused on to make use of the information. Yeah. Are there any other like stuff like questions, opinions? Okay. If there aren't any, the first part which I kind of like covered is about observation, which is knowing what to react to. Right. So the second part that I'm covering, which is about preparation, which is knowing how to react. So knowing how to react is kind of also a very is I mean, I like to keep things simple, because when things are kept simple, then it's easier to work through the scenario and think through what might happen. Okay, so knowing how to react, there are two main dominant thoughts that I think about. The first one is risk adjusted allocation. So what is risk adjusted allocation? It really depends on what you use, but the most commonly used one is the Sharpe ratio. And Sharpe ratio is about the projected return versus the risk-free rate of return. So from like a layman kind of speak, your risk-free rate of return can be either fixed income deposits. It could be just depositing in the bank the money and earning that whatever low amount of interest rate. It could be that putting it into like, I don't know what is it, SingSaver or something of that sort. I don't use, but that's something that generates like maybe 2 or 3%. That would be like the risk-free rate of return for personal lah, okay? And then you have to consider whatever you do, you have to consider whether your asset beats this risk-free rate of return, right? And whether it is worth it, right, to take whatever that amount of risk against this risk-free rate of return. That is the thought lah, okay? And it's also just nice that this risk-free rate of return is very closely correlated to the US 10-year bond yield. Yeah, typically speaking, is correlated to that. Yeah, I mean, I'm talking about the US market lah. But if you are looking at some other market, then obviously you have to look at that market's equivalent. Yeah. So that is the knowing how to react part, because I'll get to the why later on. And then the other dominant thought is that for throughout all the assets that we buy, they usually follow this pattern, which is that they take the escalator up, but they take the elevator down. Yeah, it's always like that. It's always escalator up, elevator down. Unless you're talking about like speculative asset, then speculative asset will be elevator up, elevator down. Yeah lah. But then so escalator up, elevator down is that there are a few things which is that chasing gains is typically if you ever find yourself in a chasing gains scenario, it means like you just see that the price is going up and you just keep buying. It's most likely a wrong plan. Yeah. Unless it is like a DCA, there's a time weighted approach to it, because that's the idea. Yeah. And the other thing is that since we know that things will inevitably take an elevator down, what is your plan when the elevator does go down, right? You have to think about that in advance so that you react appropriately, rather than you react in the moment and you actually make bad decisions in the moment, right? So elevator down, there's that I tend to look at it in like different percentages, which is like for me I look at it as like 6%, 11%, 23%, 38%, and 61%. Yeah, so typically speaking, 6% I don't really have any movement to it. Yeah, 11% I will look at the sector. 23% down I will look at like the individual companies and how they measure up to the sector. 38% is when I start to think about whether I should take minor leverage to capitalize on something. And 61% is where I think about whether I should take major leverage to capitalize on something. That's typically how I look, how I go down the numbers to see the kind of things. And it's important to know that asset versus sector has different things. One is that asset has higher residual risk and sector has lower residual risk. That means residual risk means that the risk of like the individual company making mistakes or having some kind of like regulation targeting it or something that makes it lose out on something. But then in times of great stress, this thing will actually change in the sense that the residual risk that is typically low in industry or sectors, right, they become high systemic risk, because if the whole industry is going down or the whole sector is going down, then something is at play over here that is more or less a big problem. But then the other thing, which is that the individual stock asset, right, it becomes like an opportunity, because if the whole sector can go down, but when the whole sector can go down, right, it will mean that one of them within the sector will inevitably come out on top, because they will be in a very good financial position or they are in a very good technological advantage position, and they can make use of this opportunity to gain a lot of market share. Yeah, so obviously if you are invested in that sector, or you are very close in the sector, or you are picking a company in that sector, right, you obviously want to be picking this company that has this technological advantage or this financial position that is the most well off within the whole thing. Yeah, so that is about the knowing how to react part. Yeah. So
Yeah,
Mm.
I have
Go
a
on, go on.
questions here.
Okay.
More like a statement, because I know it's easier when when things are calm now. Okay, let's look at US market, right? Now it's all like quite calm. Market all-time high. I don't know how many times I saw the all-time high, right? In the past 2 to 3 weeks. I mean, during times like this, we can always say, okay, it's expensive. I'm selling my positions, move to cash. I will wait. And I will set the how much it drops, right? Okay, it dropped 10%, I do this. It dropped 30%, I put in more. It dropped 50%, I put in more. We can actually write down all this, but the main challenges is always when the time really comes, right? It drops that much, right? Whether you have the guts to act or not. That's the tough part. Say for example, right? I mean, we are not talking about like small cap companies where you can easily find companies that drop by 30-50% over a short period of time. Just take China, for example, right? Because this is the one that is huge market. We know that their GDP growth is so high. We know that their tech companies are promising. Even the stuff that they do, right? For example, like the short videos, all this TikTok or Kuaishou. All this is even like innovations that exceeded US. So they are not like chasing US, they are already exceeded US. You can take you see TikTok is so much better than Instagram and Facebook, right? But yet you look at their tech companies, the best one like Tencent, all these Alibaba, Pinduoduo. Just year to date, right? Pinduoduo has dropped 52%. Imagine that if let's say we just go back to 6 months ago, before all this crackdown actually happened. That time I think it's only Alibaba. Alibaba started late last year, so the rest are all quite fine, right? Let's say early this year. At that time, if I adopt the same mindset, I say, okay, I think Pinduoduo is good company, Tencent Music Entertainment good companies, but it's too expensive. I think I'll buy, let's say, when it dropped 30%. Or when it dropped 50%. I might say that, at that point. So it's okay. I write it down. But now, fast forward to now, it really dropped by 50%. The question is, I look at the statement that I made 6 months ago. I am not too confident to say that, yeah, I'll just happily buying because they are cheap. It's not that way, right? Because when a market or a stock price that drop, not those like 5-10% drop, when they drop by 30-50% drop, right? Usually it's not like no reason one. For sure, there is a legit reason to believe that things are bad, right? If not, then why others are selling, right? So I think the question is like, okay, now it has dropped. I need to assess the situation also, right? Like TT dropped so much, right? Since the IPO, rarely we see a good companies, like a very dominant companies. The market share in China is like 90+%. This is a company that even if they are loss making, I'm happy to buy. But look at their situation right now, right? Like the government is going after them, and share price is cheap. Are you happy or are you comfortable to go in at this kind of environment or not? So that's the question that I pose up, because assuming that the numbers that you just provided, right, like 10% I do this, 30% do that, right? But what if when that happened, the entire sentiment is so bad, can you act on it or not? That's my, how to say, my a bit like challenge you, like can you actually promise yourself you will act? Because if you will act, right, then, and proven to be right, then of course you will earn a lot, right? But let's say if the situation is the other, like Alibaba already dropped so much, then you think, okay, it should be very cheap already, then you buy, then it further drops, right? Then how? So I think that's the reason why more, let's say, investment approach that is not so active, like you say, looking at the prices drop 50%, that I invest a lot, right? This is what I call active. The other approach is that I know that, let's say, when market is up, there must be a good reason. Market is down, there must be a good reason. I try not to be so active. I know that, let's say, market drop, I will consistently buy around the same magnitude every month, just DCA. If the market up, I also DCA. This is the more sustainable, passive, like don't care so much on all this, all the news, all the fiscal or monetary I will just do it consistently because the goal is to build the portfolio over time, regardless of the market, right? If the market go up, then I will still have to invest, because sitting on cash just waiting for a pullback is also the opportunity cost is also quite high, right? Yeah. So I will just stop here and just want to hear your thought on this.
So actually, just now maybe I wasn't very clear on the percentages that I give, right? But the percentages that I'm giving was not it's not like asset or sector kind of thing. It's more of like the overall, like say, SP 500 drops by that amount, right? That's when you think about decisions to do, like what to. So let's say it drops by, let's say the whole SP 500 drops by 6%. Like say in 1 week it drops 6%. Okay, then if it drop, because SP 500 is like a index, and the index have like is kind of like a representative of like the strength of the US economy, right? So if it does drop by 6%, based on your portfolio, what do you want to do regarding it? Yeah, that's what I mean by that. So if let's say SP 500 drops by say 60%, what do you want to do regarding it? Right? It's not about like say your personal asset drops 60%, because personal asset drops 60%. That is kind of like that is what is classified under the residual risk. That means you never know whether like the regulation affects only a single company. Like maybe there's a Google lawsuit, there's an antitrust lawsuit, that kind of things. But it's highly unlikely that it will affect the. It's highly unlikely that all these kind of lawsuits will affect the entire economy or affect the entire sector, right? But if the sector does drops, yeah, I mean, if the whole index does drop by say 40% in 2 weeks time, like during like say the March scenario, right? The March 2020 scenario, you know that like something bad has happened, and this something bad is affecting the whole in the whole economy. But affecting the whole economy, there is this idea that no matter what, some companies are going to turn around and make use of this crisis and get back stronger. Some companies are just going to die because they are already in a bad position before this situation happens, right? So that is when you start to think about regarding your portfolio, what you want to do with it. Yeah, so that was my idea of like the looking at the drops lah, in terms of like,
but
yeah.
But then my question is still the same, because you are right that, okay, if we pick individual stocks, of course, it's more volatile because it's specific to certain sector and so on, right? But my question is still valid. Let's say if we look at the broad market, because let's say S&P 500, I don't know, level, let's say 4,000 plus right now, right? If suddenly within, let's say 2 months, 6 months time of period, it dropped by 30-40%, right? Which is huge drop, right? It won't drop for like no reason. It won't just like, okay, corporate profits or okay-ish, maybe some disappointment, a bit of disappointment here and there, then suddenly it dropped 40%. That's not going to happen, right? It has to be like huge event, something that make people like really panic, then it will drop like 30-40%, right? Like COVID is a good example, and even COVID, right, where the entire market, not the entire, the almost huge part of the economy is shutting down, and yet the market, I think, dropped by 30+% only. So the scenario that you just mentioned, right? Like, I don't know, I the percentage doesn't matter, whether it's 20, 30, 40, 50% doesn't matter, but there must be some reason, right? So that reason we don't know. For example, like what if let's say the inflation just shoot up by 7% and then sustain there for 3 to 4 months, and Fed have to rise the Fed fund rate by 200 basis points, then market tank by 40%. So are you happy to go in? Because right now all the companies that have debt on their balance sheet, right, the cost of financing is just so much higher that you can see that the corporate profits in aggregate will drop by a lot, right? So they are not making money, or they make a lot less money compared to now. And the market dropped accordingly. So yes, it is cheaper by 30%, 40%, but it's not necessarily cheaper relative to the fundamental worth, right, of the entire aggregate stock market. So you really don't know that, right? You still need to assess the situations, right?
So
So
that
the
is
percentage, yeah.
that is the idea of the bond yield curve, because yes, the interest rates can rise, and when the interest rates rise, some companies are going to fail because they are already heavily in debt. Some companies are going to do better. So that represents like opportunity point, which is that you know that this event is happening. Do you want to actually take advantage of it, to think about, should I actually make a long-term play over here, and think about like maybe within a certain sector, all these companies are just doing like that, but one of them is a standout company that is going to just do better than the rest, and this represents an opportunity in which they can actually take over more of the market. Yeah, that is what I'm getting at, which is that
Yeah.
which is what I talk about regarding the residual and the systemic risk. In normal times, that means stable times, right? The residual risk of the sector is low. But when in abnormal times, that means something drastic change or something, the systemic risk is high. And during a systemic risk high period of time, it represents an opportunity for some companies to actually take advantage and to actually like dominate the markets. And this is typically the case that has happened for throughout history, throughout whatever things it is, that some companies will come out on top during a crisis. So I mean, you can do passive investing, which is there, but passive investing might not be that. It could be that the sector is down for the next 2 or 3 years, but within that sector, one company is doing relatively well or fairly well because it's taking over, and then once things pick up, that company represents more of that sector compared to the rest of the companies. It could be something like that. So it's whether you, I mean, it really depends on what sector you play and what you want to do with it. That's why it's about identifying the opportunity points, and then based on your own assessment, you see where is the best opportunity point to make a thing, to make a decision, because otherwise, if you do passive investing, actually a lot of people think that passive investing is normal and is going to do well and things, but actually the truth is that passive investing is also very heavily affected by the Fed, which is that the decisions of the Fed is what drives the passive investing up over time. Yeah, and generally speaking, the Fed makes very, very like stable decisions, but then the thing about it is that the thing about it is that it's not right to say that passive investing will always is always the best, because you are basically just putting your decisions into the hands of like into the hands of the market, and the market can do things. I mean, I'm sure you all heard of like short-term debt cycles, long-term debt cycles. That the thing is that short-term debt cycles is usually within the span of like, say, every 10 years or something. Every 10 years you notice like now is like this COVID thing, and 10 years ago, roughly 10 years ago, is like the subprime mortgage crisis thing, and roughly 10 years ago is like the Asia financial crisis stuff, and then even 10 years ago, is it 10 years ago? I'm not sure, exactly sure. Sorry, I'm probably missed out the whatever crisis in the 80s. But in the 70s, then you have like the oil crisis, the oil cartel crisis things. You have all these kind of things. These are all part of the short-term debt cycle. But there's also another long-term debt cycle. And the long-term debt cycle is the one that people usually are not very familiar with, which is that the first notable long-term debt cycle was the Great Depression time. Right. Then the second notable long-term debt cycle was during the 1970s, the Bretton Woods Agreement, that they reset the long-term debt cycle by moving it off the gold standard. So now it's like another 50 plus years already, right? There's always as time goes on, and you'll notice that it's always in times of like great disparity, right? That long-term debt cycle is reset. So like in the 1930s, the long-term debt cycle reset that one time. Then in 1970s, the long-term debt cycle reset again. This time it reset because the US government wanted to move off the gold standard, because one thing is that the cost of war from Vietnam, they just came out of the Vietnam War cost and they had quite a lot of debt there. So moving off that gold standard actually effectively clear away a lot of their debt. Yeah, then now it's like the long-term debt cycle, the debt again now is piling up all the way. I mean, I won't say that it will reset now because it's impossible to see when it will reset. But what I'm just saying is that passive investing works on the long-term debt cycle. And the long-term debt cycle has proven that in 50 to 70 years, that typically there is this kind of great change, great financial system change that will throw all these like passive investing metrics out of whack. Yeah, you can see like during that those times, the passive investing thing was entirely out of whack as well.
Yeah, let me add on the passive investing first, because I think the I'm not saying that the passive investing is the best. That's not my point. I'm just saying that because when we talk about passive investment, right? I think one very important concept is whether you believe the market is efficient or not. Because when you say, okay, when something happens, interest rate goes up, the market tank, it's not like every company's drop by the same magnitude, right? That's your point. Then you say, okay, some companies will do better than the others. I mean, it doesn't has to be interest rate, right? Even COVID, when COVID strikes, some companies will do much better compared to before COVID, and some actually have to close down, right? So I think the impact of any event, right, will not be uniform. Some benefits, some will bankrupt for sure. The thing is, when you have that assessment, right, you look at, okay, now this event happened, I look at the situation, I look at the data, then I need to act, right? But the data that you look at is also looked at by others. Is there any data that you are the only one person that have the information, or maybe not one person, you are the minority, you are in the minority group that has the privilege to certain information that others don't have, right? So if the data that you read is also accessible by others, like interest rate goes up, you look at the balance sheet, you know that Microsoft is going to do well because they have so much cash. Berkshire is okay because they have so much cash. The cost of financing is not a problem for these companies. They can even earn much better returns, right, by utilizing their cash that they have, right? So they will do better. You know that, but others also know that. So in the event like this, right, you can see that, oh, okay, market drop. Some companies drop by 90%, some 80%, and Berkshire dropped by 15%. So how do you assess at that time that, okay, actually, Berkshire dropped by 15%, actually, I think is dropped more than what it should be, or dropped less than it should be, right? So it's really, if you are like playing on the same level as others, what is the age that you have during those events, right? I think the age all comes back to I read somewhere, right, they said that there's only two main group, right? One is either you have the data that others don't have, or you have a analysis tool that is better than the others. So which is the case, right? If you don't have, then the easier way to play is just to take on the approach that is follow the market at a consensus way, which is closer to the passive investment, right?
Okay, but
Yeah.
here's the thing. All these that you say is true, but then the question now is that yes, the market. I mean, I'm not going to question whether the market is efficient or not, because it can be efficient, it can be inefficient, whatever the case. That is something that can be taken into account for. But what I'm questioning over here is that in the event that something like this happens, right? Are you ready? Are you ready, right, at that point in time to take the maximum advantage out of it? That means, let's say we go with the example that you gave, like other companies drop by 80%, Berkshire Hathaway dropped by 15%, right? Then that situation happens. Are you, if you know that that is definitely what will happen, and that's the case, right? Are you willing to actually leverage into it? Because if you are willing to actually leverage into it, and you know that that's going to happen, and the chances of like, say, the chances of like that, and you know that the market is doing the same thing, right? Then it represents an opportunity for you to make more out of it, right? That is the thing, and we must understand that there's this when people are dealing with large sums of money, right? The idea is that, okay, passive investing is easy, because passive investing is like, I'm just going to do this. I'm just going to put in, like, say, I don't know, like 3,000 a month, 4,000 a month or something. And no, that's just going to be it. Yeah, right. But then that is like just it kind of, you realize that it's kind of like a discipline. Is really like it's actually discipline already. Like you are disciplined to, like, say, put in 3,000 or 4,000 a month. That's like your discipline, right? Why can't the discipline be actually be like, if that in the event of something is, in the event that something happens like this, I have the discipline enough to actually leverage into it. It can also be that way, right? It's just a matter of like you think that, oh, things drop and you have like 30% dry powder or something, and you think things drop now and I think it can't go any lower, I'm going to buy SP500. But why do I have to buy VOO? Why can't I buy like the 3X one? I can buy the 3X one, right? It's leverage, right? I mean, how likely is it that if the market has really dropped by 50%, that it drops by another 50% and wipes out all my stuff, right? I mean, if you think about that, why not just leverage into it? Then you make above that usual return. That is the idea behind it, which is that, in a sense, active investing is a form of passive investing as well. It's just that at what level are you disciplined enough to make that decision? That's what I'm saying. Yeah. I mean, you all understand what I'm saying, right? Yeah.
Yeah, I understand.
Yeah, you all can still hear me, right?
Yeah, you can.
Hey, thanks. Maybe I can make a comment, because I think when I was trying to catch what YCX is trying to lead us in the discussion, and then looking at the title for this discussion, and I felt that it's a little bit inappropriate. I think what YCX is trying to get us to do, right, is to think about the execution part of sometimes our plan, and actually how to, I would say this is a little bit like how the kung fu be behind, whether instead of talking about individual asset class like equities or what, but it's how do you manage an investment portfolio which is likely to be volatile. So So I think the discussion was something like that, and
Yes,
and I
correct.
think I think Bunti brought up a very good point when he was like trying to critique in a certain way that plan is well and good, and I do subscribe to a plan something like that. But sometimes some of these things tend to be a little bit tainted by the behavioral part of things, which he bring up a very good example that we're currently going through right now, which is the China situation. So I think that is quite a good discussion. I think the only point that I wanted to two things are, I think one thing I echo what YCX say. I think what he says is quite important in the sense that you have to think about a little bit of like chess play like that. How the thing evolve, how is it the probability of things, how it's evolving, and roughly what you will do in those situations. And if possible, try to do some preparation beforehand. Like if we're talking about individual stocks, it's like if let's say it goes, if let's say the general market goes down, right? What are some of the picks that you're looking for? So I think YCX, he gave a very good breakdown. Like, oh, okay, this will be something that I look at if the let's say the drawdown is less than 10%, and if it's larger, right, then I'll shift to, instead of looking maybe adding on in general exchange traded funds or something, you add on to something more individual. So in order for you to add on to something individual, you have to have a certain like shopping list or something in that sense. But I do echo like what Bunti said. The plan is good. Sometimes it's also the execution, and definitely I think what was actually maybe not highlighted so much or discussed so much is usually when things goes down, right, there is a conviction issue. There is a conviction issue whether you're doing individual stocks or even on a broad level, because in a certain way, the last part of the discussion we were talking about more drifted to the sense that actually you can do passive investing, and that can be more mechanical and all that. But I do contend as well, conviction is on a different level, on a very different level. Like individual stocks, if we talk about conviction, we're talking about on individual company basis, whether they will be able to survive or not, or whether they will thrive or not. On the portfolio, which is a passive investing, is usually the portfolio level, right? The conviction would be a little bit different in a sense like, would the general market survive? So different people, their conviction level is different based on how much they know, and that will be probably the part that maybe even if let's say we say someone is a passive investor, right? They might not be able to execute in the way that I think YCX think they should execute, because some of them they would, because they understand how this works better. There's some of them they probably won't, because their friends tell them, hey, this is the best method to do this in a very low cost manner, and then they just do it. But when it happens, they realize that basically their conviction comes into question. They should, the rule book tells them that they should be buying now, but they are very torn due to like how they should think about this situation. Yeah. So, and perhaps maybe the last part is that more on YCX point that I think maybe the market conditions have changed due to how the Fed does it previously, and that may be affecting the passive market to a certain extent. I do agree. Maybe to like how much that passivity is actually impacting the liquidity of the markets and how it affects flow. But there's also the other aspect, in the sense that let's say we don't, instead of this period, let's say we time travel back and then we start investing somewhere in the 1980s to let's say 1990s, and passive investing, you can invest in different markets. You could possibly be investing in, let's say, an emerging market like Hong Kong or something, very volatile. But let's say you are able to invest in, let's say, the MSCI Hong Kong and all. It's very volatile and all that, and probably it's under a different regime. But if you look at what we're seeing, why we be living in, let's say, passive investing, is because to a certain extent we see how is the spectrum of returns that we can get, even including those periods. And I will contend that during those periods, maybe it's still considered maybe a certain short-term debt cycle, but in a certain sense, the Fed impact on, let's say, a certain niche country like Hong Kong might be very, very different. And the results for them, it might still work out that way in a passive manner. But to be fair to everyone, I think the behavioral part affects almost different styles. Whether you're more macroeconomic focused, you're a passive investor, or an individual investor. Because in a certain sense, when the prices starts coming down, right, those people who are more clear-minded, or that they believe in certain ways, and they are quite deep within that conviction, perhaps they will be able to execute better compared to those people that is in two minds, or that they have doubts in their plan. Yeah, so that's just some thoughts of mine.
So actually, you're very right on a lot of those points, and I actually have that as like the part 3, which, if you see in the picture I posted in the chat, is about execution.
Okay.
Yeah, it's about execution and understanding reaction, because the first part is about observation. Observation is about observing what's happening. The second part is about preparation, which is preparing like the different scenarios of like what happens and what you want to do when something happens. And then the third part is about the execution, which is to quote like Sun Tzu's one of his sayings is that without constant practice, the general will be wavering when the crisis is at hand. So obviously that is one of the reasons why I do have some suggestions on like how to actually execute, because executing is ultimately, you can have a lot of plans, but if your execution is wrong, then you're just going to fail no matter the plan. Yeah, that part I agree a lot with. So to actually put it across very simply, right, which is that you have to know exactly where you stand. Where you stand is something that is like values driven, right? So whatever that you do, there's always a breaking point. There's always a value point that you stand by. Be it like, say, no matter the amount of money that you are investing in, because at some point there will be this value that you are being tested on. All right. So the simple example is that I'm sure many of you, I don't know, maybe I think probably everyone here has probably talked to like an insurance agent before. And the insurance agent, you know, their playbook is very simple. Their playbook is that it's actually, I understand their playbook, and their playbook doesn't really involve telling you the numbers. Because if they tell you the numbers, right, they more or less have lost that sale already. Yeah. And why I say that is because when you go through an insurance agent, you pay the insurance agent fee, and that's what the insurance agent earn. But actually, the insurance agent, the best insurance agents don't sell you based on fees or based on whatever. They sell you based on questioning your values, and questioning your values result in knowing exactly where you stand. That means like you can say something like, "Oh, I'm a very I'm a very risky person, right? I'm a very risky person, and I like to take maximum risks and things. But then they will ask about like other things, like what about your family? What about this? What about that? And then that's when you start to waver, and that's when you start to think about other things. And then that's how they close in for the sale, because they manage to get you to question your thesis, right? So in the sense, knowing where you stand is important. It's important that you question yourself on all these first, and you prepare for all these scenarios, which is that what if tomorrow I'm in a crisis situation whereby I lose 50% of my portfolio in 50% of my non-cash portfolio. What will I do here? And when you go through these kind of scenarios, then you can think about, and you write them down or something. Then when something like that does happen, you can look back and you think, hey, when I did think through this scenario before, and back then this was how I was thinking, and these were the factors at play when I was thinking through this scenario. Then I compare with now, this situation really happened. Are the factors the same? If the factors are the same, maybe I should just stick to my previously made plan and just execute based on that, rather than whatever emotion is driving me now. Yeah, that is one way. But if you never make such a plan in advance, then when it does happen, you'll be like, I didn't plan for this, and I think I must do something about it, or I think I must not do something about it. And inaction is also a form of action, and it could lead to further losses or whatever. I don't know. Yeah. So that is the thing, which is that to prepare and to execute, right? It involves looking through all the possible scenarios and playing them out, writing them down, playing them out based on your portfolio, what you would do, so that when that scenario does arrive, right, the unlikely scenario that does arrive, you know what to do with it. Yeah. And you know, like you thought about it when you were in a calmer mode, rather than you think about it when you're in that panic mode. Yeah. So yeah.
No, I'm thinking, yes, I definitely agree that planning is important. I mean, everyone should plan what they plan their actions before things happen. And then you besides just like the standard normal assumption that, okay, if these things just go smooth, what should I do? We should also plan for some bad events, some good event. What if market meltdown? What if market melt out? What should we do, right? But actually, I also just want to point out that planning is one thing, but when the things strike, sometimes when things get scary, I think the challenge is not just the execution part. The challenge is really to manage the emotions. I can share a bit on my story. I think I shared before, but let me share this screen. Hopefully you can see. I mean, I believe that there are many here who joined the group, maybe not when I started this Telegram group. So now I'm actually sharing my portfolio. So actually the purpose I'm doing all this creating this Telegram group and also sharing my portfolio on YouTube, right, is essentially for this kind of sharings, right? So you can see that my portfolio started in 2017, right? And I started like doing like what you describe as a DCA, like a mechanical DCA. Okay, the number is a bit very small, but I hope you can see. But you can see that from 2018, right? I do like almost like constant 2,000 per month put into the portfolio, and I don't want to describe 2018 whether it is like a good year or bad year, but what I did is, okay, every month 2K, 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 then down to around, let's say, February already can see that the market is like dropping, and I step up my DCA, right? I think this is exactly like what YCX you just say, right? Okay, market drop, then you see that market is more attractive, then you put in more monies. Then in March, right, which is close to market bottoms, right, you notice that my DCA is not like every month. It's like every week You can see here, March 10, 2000, March 17, 2000, 23rd of March, 1000. Then subsequently every week 1000. Why 1000? It's because I really run out of money already. I budget all my monthly expenses, all budget to like very very tight lah. So essentially all money's just pour into the market. Then after that, even in between let's say April last year to let's say September, right? I step up my DCA by a lot because that time Fed fund rate is already very low. Okay, market is already recovering. It seems that market is going up. So that's the active decisions that I made where I put a lot more monies into my portfolio during this period. So all this, right, I can actually paint a picture that, wow, I'm like the genius, right? You see market drop, I just all in and I become rich, right? So sounds like very smart move. But then to be honest with you, when I put money in during March, I don't think that is like the emotion that I had that time, right? It's not like, wow, market drop, I think it will go up for sure, I put in money. It's not that kind of feeling, you know. It's the really shaky kind of feeling, that not sure feeling, that when I put 1000, I'm thinking that, okay, just put that in, it could drop by 20% next month, but then don't care, just put in. Then I put in and it dropped. Then next week, let's try again. Let's put in another 1000. And every time I put in the money, I tell myself, yes, market can drop. Of course, right? Because who knows how serious is the COVID situation, right? Because if you recall during March, that's not like everything is clear cut, right? We don't have visibility on vaccine. We don't know. Okay, there are some countries, the US are shutting down their borders. All these things happening. We don't know how long these things will drag. Even as of now, we still don't know, right? But now we have vaccine, so there's a bit more visibility. But what I'm trying to say is that it looks easier, let's say after, like now market has already go up by 100%. I can always, my whole power, just say, you see, I so smart. I tell you, market drop must buy one. You have to buy, you will become rich. Okay, talk easier, but you're really entering that kind of situation. And when you click the buy button, the head is a bit shaky, right? Then you know what I mean by, okay, in theory, it sounds easy, but in practice, not so easy, like where the finger is shaky when you click the buy. So I can say it's in a very, like, it's quite funny because we are out of this storm, right? Okay, the storm happening, it happened March to, let's say, June last year. Now I can already see the unrealized gain already out of the crisis. At least we look at the stock market. So anything I can say, right? But at that period, not so easy lah. Which is the case for, let's say, China market now. I can also say that, wow, you buy now, you see Alibaba, good company, you buy now, for sure you earn one. But you try, let's say in the past few weeks, you try put money in and you see it drop, then you put money in, it drops, then try to describe the emotion or your feeling at that time, right? Not so easy. But let's say in the scenario that 1 year later, 2 years later, market goes, Alibaba share price go up by 70%, 100% from current level, right? Then you can say, oh, you see, I so smart, right? So it's always like at that time, you are not sure one. Anyone who could tell you that, okay, I can tell you for sure, then it's really, I mean, it's a bit like illusions, I would say.
Correct. So completely agree with all those. That's why the idea is that if you see my picture, right, the last 3 or 4 lines is that to actually train the resolve, which is that when the crisis comes, you'll be calmer. And how do you actually train resolve? I actually have like 5 different ways to actually do through it lah. Okay, one is backtesting. Backtesting means that you look at whatever strategy that you're employing right now, and you look back in history to identify similar points, and then you run through a backtesting scenario to see whether it would have worked out if you had done this. That's backtesting. So that actually gives you confidence that the scenario that you do will play out. So then the other thing is gambling. Because actually, to be very honest, investing is gambling. Right? There's no I mean, people like to say, oh, investing, oh, that you actually can predict, you actually can look at all these insights and whatever things, look at what discounted cash flow model, blah, blah, blah. But the truth is that investing is basically a whole bunch of people taking in a pile of money. They put in that pile of money into different areas, and then they see which area wins out. Yeah. And they do it over long term. Yeah. But it's actually still gambling. So setting aside some amount of money to actually gamble is actually a good way to train resolve. Yeah, because you start to disassociate yourself away from the money, and you start to be less attached to that money. Yeah, which is also how it ties into the part whereby I say you have to know exactly where you stand. So like, let's say if you go play a poker, Texas Hold'em game, right? And then you play like, say, 150 pot or 100 pot, that kind of, buy 50 buy-in or 100 buy-in, that kind of things. And then when you play, you kind of notice that poker is the best way. Poker, you immediately feel the pressure. You might start to crack under it. Yeah. And when if you are new to the game and you start playing, even if you understand all the rules, it's very easy for someone to see that you have cracked. And then when they see that you crack, right, they are able to take advantage of it. So you can think about that as like the market, the kind of market forces that you'll be facing when it comes to these kind of things. So gambling is a good way to train resolve. Yeah. Then the third thing is to research and run through scenarios. Research and run through scenarios, I mean, it's the same, it's similar as backtesting, but backtesting is more of like backtesting to me is more of like a charting approach, which is that I overlay charts, I look at charts, I write strategies on TradingView, and I see how the strategies turn out. Research and run through scenarios is just doing that theoretically to see and then to understand, because certain things you are not very sure that it will happen the way it will happen. Like if Fed funds suddenly go down to 0%, you think that it means that it will mean that the assets go up even more, but it could also be that if Fed funds go down to exactly 0%, the assets will actually drop, because people start to lose confidence in the economy, or people start to think that the Fed does not have its shit together or stuff like that. It could be these kind of things, yeah. And then the fourth thing would be to talk to your peers, relatives, significant others on the plans. Because one thing that we usually don't think about is that when we make decisions, we tend to think, oh, it's an individual decision, that kind of things. But when it's a stressful period, we tend to talk to friends, talk to family, or whichever the case, and then we will ask them for opinions somehow, right? And we think that it might not affect us, but when it actually happens, right, then you realize like the mindset of your friends and family will affect you. So if you have plans and you talk through the plans with your family in advance, then you can also record down the reaction and think through, and then that would be how you actually train your resolve, because you might be your family and friends might not have the same kind of thought process as you, and during a kind of panic scenario, they might be thinking differently, and then you can record down their reaction and think through, hey, yeah, before that, this is what we discussed upon. Why is it that it has changed? Why is it that people are panicking now? Then you get down to the key questions of like the key fundamentals of the panic, instead of like you just think about the emotional parts of the panic. Because chances are, if you actually have done a plan about it, you can identify that this plan is based on factor A, factor B, factor C. Then when the scenario does come, you can check through whether is it satisfy factor A, B, C, or is it factor B has like some change that is different. Then you focus more on factor B and think through. So actually A and C is the same. The only thing that's different is B. Should I actually should I commit 100% to this plan that I think about, or maybe because of factor B being a bit different, I maybe just commit like say 60% of my plan to it. I mean that's where the risk adjusted allocation comes in, yeah, of in part two, like knowing how to react. Yeah. And also important to know is that all the views are important. Be open-minded, because it's impossible to know what is right or wrong. The smartest investor, or whoever, Warren Buffett, whatever, they can still be wrong, right? Like Warren Buffett was wrong on tech for like over a decade or something, right? The past performance does not reflect present performance in any way. Yeah, you can look at past performance, and past performance is just thinking through why people made the decisions they did. But don't blindly copy past performance, because you copy past performance is just leaving it up to chance that the current scenario will play out exactly according to past performance. Yeah. And then the last thing would be that when you think through all this, it's good to actually go for a bit of exercise, cardio. I mean, I recommend like say running, swimming, cycling, or hiking or something. Something that just some monotonous exercise activity, because that actually, I mean, this is a physiological, but it's also a physiological affects emotional kind of thing. When you actually go through that, then you go and exercise, you actually feel calmer and execute better. Yeah, that's the thing. Like right now, I mean, I can kind of like share that I'm always looking at because I'm playing with futures. So playing with futures means that a small amount of change leads to large amount of gains, or vice versa, or large amount of losses. So like I'm just looking at like say the Bitcoin right now, and it's dropping, and to many people it doesn't matter because it only dropped by $300. But to me, I'm actually, because I'm playing futures, so I'm actually looking at other things right now and thinking through what I should be doing just by this $300 drop, whether I should take advantage of it or whether I should do something, whatever. Yeah. So this is also like the gambling portion that I'm talking about, which is that it's important to constantly test your resolve by doing some amount of gambling, right? So that yeah, you're prepared for that lah. That's my point. Yeah lor. Yeah, so I guess that concludes like what I have to say. Yeah.
Good stuff. Any other questions from the floor? Everyone's so quiet. Can just unmute and talk. Don't be shy. But the exercise one is quite good, I'll say. I mean, regardless of whether you're trading or what, right? Whether you are you are just like investing or DCA or not, exercise is always good. To reduce stress.
I mean, obviously, if you are trading minute charts, then that's a different thing. But I'm not trading minute charts. I'm trading like 15-minute and hourly charts. So yeah, that's fine to me. Yeah.
Yeah, still stressful. Anyone questions? I think just now there's one question asked me about like what did I buy during, let's say, 2020, right? I think 2020 early I was buying ETF, like those spot market one. Then from March or April onwards, because once it's clearer that this COVID situation will last longer and not just like a blip, right? So and I see that tech stocks will benefit, and I started with QQQ, and then subsequently I straight away buy all the big tech, like the tech companies, like Microsoft, Apple, TSMC, all this. That was started, let's say, from March onwards. So until now, I think I stopped buying ETF for quite some time already. Just recently bought the iShares Hang Seng Tech, but that's very, very small. Most of the time, every month this year, just buy individual stocks. But not as stressful. Definitely, I know trading, like whether it's 15 minutes bar or the 1 hour, I think they are all quite stressful because you set a stop loss and then it hit, then you have to get out already, right? It's all automatic. Then you have to admit that okay, this is a trade, losing trade. So
I mean,
it's always there.
typically, don't set stop loss one. Yeah, typically is don't set stop loss. Yeah,
Sorry, no set stop loss. I thought the futures they were set for you, right?
Stop loss at liquidation yeah lah. But you typically I mean there are different ways of playing it lah. You can always create an account and play 100x if you want, but then that's not my approach lah. My approach is typically to the leverage I'm playing with is low at the beginning. I mean there's an equilibrium price, and the leverage is dependent on how far away it is from the equilibrium price lah. Yeah, I look at like certain charts based on volume analysis as well to actually play that yeah. So there's that yeah. So typically stop loss is not important because the idea of stop loss is even if I want to set a stop loss, I would actually write a script to set it on my end rather than set it on whatever exchanges, and because you never know if the exchange might be doing some kind of stop hunting. Yeah, because they have the order book, and if they have the order book, then they can just look at where there's an opportunity for them to make profit, and then they'll just go for stop hunting. Yeah, so typically no stop loss on the exchange. Yeah, I mean it sounds very unconventional, but the conventional doesn't apply when you're playing with markets that are very volatile. Yeah.
I'm pausing to see if any other questions. If not, it's also already 12 o'clock. Already noon, time for lunch. I don't know. Anyone, any questions? If not, I'll pass to YCX for the closing segment.
Closing segment is okay lah, simple. Ultimately, you know exactly where you stand. I mean, you can just follow the 3 points that are listed over there, which is knowing what to react to. So you observe, then you prepare, which is knowing how to react. And then during execution is understanding your reaction based on your plans. So you during execution stage, it shouldn't be about making decisions based on your emotional state, but rather you should be making decisions based on your plans and comparing the different scenarios on like the plans like that. It's like you know when you're in NS or something, like those officers or whatever, they have like those kind of like war scenarios and things. And then in a real time of war, right, they always look back to those scenarios as well. And when they look back to those scenarios, they think, hey, these scenarios are similar or different. What has changed? What are the factors? So based on this, the scenario will play out like that. We change accordingly and things, and we improvise in this area and that. Yeah, because you think about the military expenditure is high, but at the same time, military expenditure takes years because you need training, you need training, and the equipment lasts for like decades. So even the plan itself is like a multi-decade kind of plan, and multi-decade kind of plan, they have plenty of time to actually run through a lot of different scenarios, and then if and when something does happen, the militaries just execute based on the scenarios and change accordingly, just the small factors, but overall the scenario is already laid out already. That's usually the case, and that is the kind of approach that I would say regarding long-term investing is the same. Yeah, that's about it. And then of course, always like have a bit of battles here and there, which is that Like if you are the US, you always start a few small conflict here and there to keep your military operationally ready by sending a few people to die and fight wars. Yeah, unethical, but that's what the US that's what the US does. Okay lah. Yep, that's all.
All right, cool. I think I have nothing more to add. Other than have a plan and preferably write it down rather than just have a plan on your in your brain.
Yeah,
It-
have
it
multiple
makes some
plans.
difference. Yes,
Have multiple plans and
for different scenarios.
Identify the factors, right? So that when something does come about, you focus on the factors rather than you focus on the emotional state. Yeah.
Yep, that's right. That's right. Good advice. Thank you so much.
Yeah.
All right, thanks a lot to everyone joining in. So I think I'll close the call here and enjoy your lunch.
Thank you all. Goodbye.
Thank you so much. Bye bye.